So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions.
Hey everybody, Brett Swarts here, Capital Gains Tax Solutions. Excited about our next guest. He's in the U.S. Army Forces. His name's Edwin Epperson. He's out of Florida, and he was a Green Beret for 13 and a half years, but he took his leadership and his growth in the Special Forces, and he moved it into commercial real estate lending and short-term rental lending. He's done over $15 million and over 100 loans in just the past 6 years. And he really has a heart for service and helping people and educating people on their options. You're going to learn about diversification and the importance of maybe considering that for your current wealth as it pertains to investing into hard money lending or the lending business. You're going to learn about some of the things that lenders are looking for to mitigate risk, and just overall kind of the wealth transfer that's happening right now for baby boomers who are looking to be out of the toilets, trash, and liability, and they can still be in real estate without having to take on all the debt by being a lender to other real estate deals. So with that, enjoy the show, and please share this if you find value in the show. Thanks so much. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to grow your wealth. I'm your host, Brett Swarts, and each episode I'm joined by some of the best financial independence and passive income wealth advisors in the world, where they share their stories, their ideas, and inspirations, so together we can make complex tax deferral strategies simple and passive income plans achievable. Our next guest is on the lending side, and even before that, he served in the U.S. Army Special Forces, Green Berets, for 13 and a half years, and he has served our country with 8 different combat tours and all over the world. And he really, honed his leadership skills, his communication skills, and how to handle extreme stress of combat and make decisive actions. He also manages a portfolio and helps lead a group called the Deployed Capital Group, and he's done over 100 plus loans during his past 6 years, with just over about $15 million in AUM. His experience in managing private investors' capital, mitigating risk, capitalization on market opportunities, and building long-term foundational relationships with institutional investors brings a wealth of knowledge and experience to us today. And so I'm excited to welcome to the show Edwin Epperson. Edwin, welcome to the show.
Thank you, Brett. It's good to be here.
Hey, will you give our listeners a little bit about your story and also your current focus?
Well, I think you did a pretty good job there. My story, to cut to the chase, I always wanted to invest in real estate. That's where my business is at. And I did what many people do. I started to research how to buy a property, how to fix it up, turn around, sell it for a profit. And however, that's not the side of the table that I fell on. In 2014, my last trip to Afghanistan, I was literally on the side of a mountain in Afghanistan, and I was able to close my very first loan on a property that was being fixed by a borrower in Pensacola, Florida. And I fell in love with the idea of being the bank, becoming the bank. And so from that point forward, I went ahead and let my leadership know and my team that I was going to be heading out. I was not going to re-enlist. So that had me about a year out. And so for that last year, all I did was set up my business. Now, before I actually made my first loan, I had taught myself about lending for almost 3 years. So I studied the law aspects of lending. I studied the risk mitigation aspects of lending, how to do underwriting, how to do processing, everything that was necessary in the state of Florida for me to be able to do that. got out of the military and took this head on. And so that's what we do. We actually loan money to real estate investors, typically short term, 12 months or less. And we also have a private fund, an investment fund where capital investors can park their money, and we manage that capital through three divisional approach to investing.
Let's dive in right into that fund and kind of some of your average returns that you're helping to achieve for folks. And as well, I think you mentioned before the show, we were talking, you focus a lot on fix and flips, short-term type of lending. So walk us through the average deal and then walk us through your fund.
Yeah, absolutely. So the average deal, just like anywhere in the United States, the dollar amounts fluctuate. Out there in California, where you're at, Brett, your all's dollar rates are much higher than here in Florida and let's say even Alabama or Georgia. So the dollar rates are going to fluctuate. What typically doesn't fluctuate, at least for borrowers that have a good solid number or grasp on the numbers, are your loan to values, or what is their purchase price compared to the value, the as is value. Our goal is to borrow against or based on the after repair value, or what we would call the LTARV, the loan to after repair value. And so those numbers play into what a borrower brings to us and how much money we require down. I would say the industry standard is pretty much 20% down on the purchase. And then depending on the borrower's experience and how they're approaching their project, what type of team they have in place and their experience, we will finance 100% of the renovation, or we won't finance any of the renovation. It just depends on the scenario and what they're looking at. Typically, what most borrowers that we are seeing right now in the United States, and this goes from all spectrums. Now, some places are going to be, the margins are going to be a lot smaller, a lot tighter, but we are seeing here in Florida good margins after everything's said and done. So the net profit is typically between 13 on the low end. And normally, if you're getting a profit margin of 13%, you're hoping that that property should be fixed and sold in 4 months or less for you to assume that type of risk. The ones that are taking between 6 and 9 months, or typical profit margins are between 15 and 18%, 18 being high. If you've got a borrower that's a hustler and they're getting out there knocking on doors, and they are what we would call wholesalers, or they are just driving for dollars, if you will, sometimes we have seen those profit margins creep up above 20%. So for the fix and flip crowd, that's really great. And you get profit margins, net profit margins of 20%. That's a home run in today's market. So yeah, those are the type of returns, type of numbers that the rehabbers are looking for.
Excellent. Thanks for sharing that. And I couldn't help but mention, but just to clarify, so these are, you go into a fund, so you're lending to people who are buying the real estate, rehabbing. So your risk is just on the lending side. And of course, if the borrower doesn't pay you back, you could foreclose on the property. You guys taking first positions, second positions? Walk us through that risk. And then also, before we go there too, you're not dealing with capital gains tax. This is partly why I think perhaps you can get a little bit higher returns, because you're going to have to pay ordinary income tax on the interest that you're earning, right? So it's part of your ordinary income. There's no real tax benefit to lending, unless I'm wrong. Correct me there.
So you're right. And it's very interesting. So lending is so unique. There's so many different ways to do it. And the reason it's so unique, and honestly, it's a well-kept secret in the whole world of investing. Becoming the bank is a well-kept secret. And there's plenty of reasons why your large institutions don't want people to understand how to become the bank and how to lend, because it's extremely lucrative. There are not that many tax benefits, but there are also not that many tax disadvantages as well. I'm sure that more than most of different ways to arrange your returns and to reduce your tax liability. As far as the fund goes, the way that we've approached it is, when I started doing lending, it was strictly first position lending. So we would find a borrower, we would loan, we would be in first position, we would go through our underwriting criteria, and that's a whole different session in itself. But it was a straight cash flow play. That's all it is. It's a passive income play, and there are a lot of individuals out there, family offices, in groups of investors that want that just passive income. They don't want the liability, the responsibility of owning the asset. They simply want to control the asset. And that's something that I believe in very much. If you control the wealth, if you control the asset, then you control it. It doesn't matter who owns it, you control it.
Can we pause there real quick, because
Yeah.
that's definitely a theme that we also have here at Capital Gains Tax Solutions with the Deferred Sales Trust. Oftentimes, what we do is people carry a note back, and they actually become the lender. They do a full seller carryback, and then the question of control comes up. Well, I don't own the trust. I don't own the property, or I don't own the question is, well, the collateral is what is securing your return. And as a lender, you have all the rights and protections of a lender. So dive into a little bit more about the control and the protections.
Absolutely.
And the collateral with the asset. Walk us through how that all works.
Absolutely. So number one, I'm very familiar with trust, and matter of fact, I love trust, but I won't lend to a trust. There are a lot of benefits that someone who puts their capital into a trust or buys properties through a trust, if they are using a trust, there are a lot of litigation abilities that are diminished or flat out rejected once you have your assets in a trust. So if by the sheer fact that you're operating in that space, your listeners have an incredible wealth of knowledge and information concerning trust themselves. And of course, your focus is the capital gains, but trust themselves are really powerful. This is a hard obstacle for many people to overcome. Is people love the idea of ownership. That's mine. That's my house. Here's my title. That's my name on that title. And they get caught up in, well, if I don't own it, then what's the benefit of it to me? And I always, when I'm talking to an investor and they're thinking of becoming a lender, or they've got money and they're wanting to lend it out, but they also have the opportunity to go out and buy a property with that money, I typically say to them, when you buy a house to live in and you're going to go and you're going to get a loan from a bank, does the bank pay your taxes every year? Does the bank pay your insurance for you? Does the bank pay your interest to itself? No. In all those scenarios, the bank controls the asset. And if you as the borrower fail to pay your taxes, you fail to pay your insurance, you don't pay the bank their principal and interest, or whatever the payment structure is you have with them, they have the rights by the laws of the United States, which our law system is based on Old English law, and the rights of the lender supersede the rights of ownership. And so if you have loaned your money and it is collateralized, meaning that capital is secured to an asset, then the laws of the United States say that that lender has the rights to take that asset to recoup potential loss or failure of the obligation of the borrower. And that's the first and foremost reason of why I believe in becoming the bank, is being the lender, is you take the same position that we see all these banks. If you look downtown, a matter of fact, downtown Tampa is a great example. Downtown Tampa has, I don't know, about 8 or 9, I won't call them skyscrapers, you think of New York, but there are 8 or 9 really tall buildings. On 7 of those buildings, there are bank names. And that's the case on any skyline of any city. You're going to see the majority of those banks own those buildings, or they have their big sign on it. So being the bank has definitely its advantages. And again, the laws of the land protect the bank. They secure that bank's loan to that asset.
Yeah, that's a great answer, and that's a great reminder that the rights of a lender supersede the rights of ownership. And then, yes, it's true. Trust by nature have some built-in asset protection, where there's times where you can get to the interest that it's earning or the cash flow that's producing, but you can't touch the principal, which is powerful. Now, shifting a little bit, when someone comes to you and says, "Hey, I want to invest in your fund," what are the odds that we're going to have to foreclose on somebody, or what are the odds they're not going to be able to pay us back? And so walk us through the process of, hey, he was supposed to borrow for 4 months. It's now 8 months. He's not making payments. The deals aren't moving forward. What's the percentage of times where you're actually having to take action?
So I would have to say I've been very fortunate. In the last 6 years, in all the loans that I've done, I've only had to foreclose on one property. So our rates of default are very low. Now, there have been 3 instances where the loan went into default, meaning the borrower stopped making their payments, or it went past the due date. In all 3 cases, only one went to foreclosure. The other 2, because we're not a huge national firm. We do loans in Florida and Georgia. So I'm very focused in my state and the one state north of us. And I know Georgia law. I've got a great attorney, a great team up there. So that's why we're comfortable doing loans in the state of Georgia, as well as the lending laws in the state of Georgia are very favorable to the lender. So I lend in places that I'm comfortable with, that I could drive to if I needed to drive to the asset and check it out, along with the contractor, insurance insurance adjuster, anything like that. But of those two that did go into default, I was able to work out with the borrower because I don't want to foreclose. Even though in the worst case scenario, we foreclose, we take the asset back. Normally we're getting that asset at a discount. For instance, if the property is worth $1 million and we did a loan, the most that we would ever loan on that property is $700,000. So if we have to take that property back, we have an equity cushion of about 30%. And then of course we get attorneys involved. That's their specialty. That's not mine, to find out how to get those assets off our books. And like you said, reducing that capital gains, because that would be a capital gains to us if we assume that asset. So and I leave that to the attorneys. I honestly, you could probably school me up on some interesting techniques if that were to happen. But for the two times that we did take that out, did not take those assets back, we worked out with the borrower. Luckily, they did not encumber the asset with any other loans. So we did a title search. We were in first position. We took the asset back, and then we were able to fire sell it for what we had into it. So somebody else got a great deal. We got our principal and all fees paid back, and then we moved on. So
and that's probably because you're focusing on your lending business, right? And your highest and best use of your time is not owning and managing assets.
Yes.
It's lending.
No.
And just a side note for people who are looking at the deferred sales trust, one of the unique advantages is it doesn't have to be like-kind property. So you could sell, let's say, that thing for $700,000. Let's say you happen to sell it for $1 million, right? And you had a little bit more time to do that. What's unique about it is you can move all of the gains and all of the proceeds into the trust, and then immediately, with up to 80% of the trust, use that to go back into your lending business, all tax deferred. And so you start to lend on the $300,000 that you would have paid in tax. In this scenario, if it's $300,000 as a gain, it would be, let's say, $100,000 savings or so, $120,000. And so you get the arbitrage there, and that's powerful versus having to go back into a 1031 exchange or having to go back into real estate when it's highly priced. I think in today's marketplace, it's a great time to be a lender because values are way up, and lending is pretty readily available right now, and prices are pretty high. So should the market turn, you have some built-in protection to take the asset back and then to be able to hopefully get it at a discount. So I don't know, but what are your thoughts on just the time, where the market's at right now? And as we're recording this, we're in the middle of coronavirus.
Right.
This is 18th or so, March. Yeah. And so we're in the middle of the crisis
17th,
here.
17th,
Tuesday. And so what's your take on the marketplace? What's going on? And just the inherent less risk by being a lender in these highly, highly appreciated times, even though the stock market has just been decimated here the last 2 weeks.
Absolutely, Brett. Well, you bring up a great point, and you bring up a very valid point. And I also wanted to address another thing, because there is so much lending activity, and lending has sort of been thrown in the spotlight as an investment or investment technique that people can add to their investing toolkit. You have a lot of people getting into the lending space. You also have, like you said, values of properties have been literally on a rocket ship for the last 10 to 12 years. So we have just been increasing and increasing and increasing. Not 12, maybe 10 years. And so after the market bottomed out in 2011, 12, it's just been on an upward cycle since. And so what you have, and actually there is, God bless his heart, there's a gentleman here in Tampa that I know personally. He had some money in a self-directed IRA, along with some family and friends that trusted him, and he was doing loans. He did not have an underwriting guideline and criteria, which I'm very big on. And these are self-imposed restrictions that anybody who's going to get in lending says, okay, if I'm going to loan my money, what type of assets, what type of borrowers. Now, within the borrowers and assets, what are the requirements? What does the borrower have to meet? And what does the asset have to meet? What do those look like? And they should write them out, a list of underwriting guidelines, almost like a checklist. That way, when you have a loan, you can go through and say, okay, this is what the borrower, do they meet my checklist? This is the asset, does it meet my checklist? And this is the loan structure, the capital stack, does that meet my underwriting guidelines? So those are really important. What you have is a lot of people getting in, and let's say that the property right now is worth $1 million. And because it is so competitive, because there are so many people entering this space, you have basically a bidding war between inexperienced lenders. And you have a lender that's sitting on $1 million, and he says, well, I know that I shouldn't loan all my money out on one project. That would be foolhardy, but man, this is a really great spot. It's a beautiful location, yada, yada, yada. The borrower's got great credit. We don't know. The deal looks solid. So maybe the lender or this investor, private investor, decides to, well, I know I should probably lend no more than $700,000, but this looks like a really solid deal. I'll go ahead and lend what the borrower is asking for at $850,000, $900,000. We call that, now you as the lender have taken the risk because you have decreased that equity cushion that is supposed to be there to protect you. The minute that you overextend, you are now assuming unnecessary risk as the lender. When the market shifts and we see property values start to drop or correct, whether they tailspin or whether it's just a correction, either way, that $1 million property in 6 months may not be worth $1 million. It may be only worth 750. And so that's what we saw in 2008, right? We had property drops in Nevada, New Mexico, California, Florida, where we saw property values drop anywhere from 30% to 50%. So as a lender, it is the onus is on you to set out your guidelines, set out your underwriting criteria, and then follow those. And what we're going to see is people breaking their own rules, or they don't even know they should have rules. They're just loaning money, which is the case of the gentleman here in Tampa. And so him and his investors he has lost their money, well over $1 million, because he did really bad loans and he didn't have guidelines.
So let's jump. Thank you for sharing that. Let's jump into the short-term rentals and some capital gains tax. So some of the clients we work with, when they're doing these short-term rentals, at least here in California, they don't qualify for long-term capital gains tax via maybe to do a 1031 exchange because they're holding them for less than a year. However, the deferred sales trust can jump in and defer that tax, which is a nice advantage of that. But you touched on self-directed IRAs and some tax advantages. Would you walk through sort of what the tax advantages are for investing with your self-directed IRA?
So it depends on depends on how the self-directed IRA is set up. Is it set up as a traditional self-directed IRA, or is it set up as a Roth? Does it have a Roth component? You can have two. You could have a traditional and a Roth. So both of those are going to determine whether you pay taxes today at today's rate, and then you're able to withdraw it later at tax-free, or you defer today's tax payment, and then when you're withdrawing it later, you're paying at tomorrow or the future's tax bracket. That's number one. So that's one scenario. If somebody's going to utilize a self-directed IRA, then that's something that they're going to want to consider, how that entity is set up at first. Then the other thing is how you're investing in real estate. If you're purchasing the real estate with your self-directed IRA, number one, you have to find a lender that does non-recourse lending, meaning that the lender will loan your self-directed IRA the money. So let's say you've got $500,000 in your self-directed IRA. You want to buy $1 million property. Well, you're going to have to get a loan for the other $500,000. Well, there are very few institutions that will loan that money to a self-directed IRA because the federal law requires them to do a non-recourse loan if they're going to loan, or if the borrower is a retirement plan. So that's one situation to where what you find is people who have self-directed IRA money, when they're buying, they just buy it in cash. The disadvantage of that is now you're violating probably the number one rule of investing as a whole, regardless of what market you're investing in, is diversify, 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 right? And so when you have a $500,000 IRA, self-directed IRA, and you put $500,000 into one property, you have violated that number one rule. All of your eggs are in one basket. The lending aspect is the same way. That's why I think fund structures are really attractive, because you can get into a fund structure and participate with many other investors in the lending, and you don't have to be the one that has all of the money for that one loan. And on top of that, you're still, all of your retirement is in that one loan. So if that one loan fails to perform and you're relying on that income to, live, you're relying on that income to supplement your Social Security or wherever you're at in life, that could be devastating, especially in today's market and economy, and with everything that's going on, like you mentioned, Brett. Having that diversification built into your asset planning and your asset protection plan is really, really important.
Yeah, and just to clarify,
And I don't know if I answered your question.
No, you absolutely did. Thank you so much, Edwin. And deployedcapitalgroup.com is where you could find more about Edwin. And just to clarify, Edwin, you have those funds, right, where people can bring their Roth to you and Deployed Capital Group, and you guys are going to be loaning, let's say, on 10, 20, 30 properties over the next 12, 24 months, and they're a small percentage of that fund, and therefore they're diversified, and the debt's not in their name or their Roth's name, and maybe they don't put all 500, right? Maybe they put 100 with you, right? And then maybe they do 100 with a commercial real estate syndication, or maybe they do 100 in the stock market, or whatever they want to do. Yep. The point is they don't have to go into the loan, right? Which I think is really what's happening right now in the shift with the baby boomers, right? A lot of them have made their wealth in real estate and businesses. But they feel trapped by the toilets, the trash, the liability, and they're ready to retire and get some more time and energy back and pass on this wealth to the next generation. But they don't necessarily trust the stock market, and they want to stay in real estate. Yeah. And so this becomes a good place to hedge and diversify, whether it be through a retirement account, or again, if you sell your asset and use a deferred sales trust, then you can actually push it back into a fund like Edwin's as a way, again, to diversify and make some good returns.
Absolutely. It's an option out there. I'm very big. I am never going to stand up and say this is the best option out there. There are a lot of different investment vehicles, techniques, and tools. I would highly encourage anybody, if they have money sitting around and they're considering different investment options, I would consider different options. Never say, hey, this is it. This is what I want to go in. And you see that all the time. And people just dump all their investment, all their retirement, all their savings into one investment strategy because they believe in it. They say, yes, this will work. I take the approach of if somebody's going to invest, I want to know that I'm very comfortable with them investing no more than 10% of their retirement into our fund, whatever we're doing. Anything more than 10%, it really starts to, and that's just a standard metric that a lot of financial planners and advisors will hold to. And that's to increase not only diversification in the assets, but also the diversification in the markets. So you mentioned the real estate market, the stock market. I personally believe that there are three primary and then a fourth market. So there are three primary markets that people can invest in, and then the fourth market, which is your personal knowledge base, learning new techniques, learning new structures like your trust that you've got set up, deferring that capital gains. And most people, when they think of deferring capital gains, they think of the 1031 exchange, whereas the trust, and honestly, Brett, I think it's fantastic. I didn't even know that these existed. So it's awesome that these type of structures are out there. And if people are not educating themselves, then they're missing out on a lot of tools, techniques, systems that can help them diversify, help them grow, help them build and protect their family's generational wealth. The three primary markets are their stock market, your business market, and your real estate market. Stock market and real estate market, a lot of people are familiar with. I would say that the business market, the idea of investing in businesses, really started to blossom with shows on TV, of course, like the Shark Tank. Marcus Lemonis is the prophet. These individuals that have money and they go in and invest in businesses, that has really become attractive to a lot of investors. So you've got those three primary markets, and then within each one of those markets, you have a lot of different assets. Within real estate, people think of real estate, but you've got commercial, you've got multifamily, you've got raw land, you've got single family, you've got developments, you name it. There's a myriad of different assets within just the real estate market. And so, if people are going to invest, educate yourself, never put all of your investment into one investment, never put all of your retirement or your savings or whatever you have, your available capital into one investment, diversify, and continue to educate yourself. Don't feel like, oh, this is if I don't make this investment today, the opportunity is going to pass me by. There are millions. There are millions of opportunities out there, and you will find one. Take your time, learn whatever the strategy is you want to implement and the tools and techniques, and you will be successful.
You got it. Yeah, we call that optimal timing, right? Investing when it makes sense for you when you find a deal. And you can find a deal in every market as long as you have enough time. But if you're stuck in the 1031 exchange and you're feeling pressured by that 45-day window to identify and 180 days to close, too often you end up overpaying for property, taking on too much debt, and buying what we call sell high, and then 180 days later buy higher. And you go, no. Our parents taught us to sell high and buy low, not sell high and buy higher 180 days later and take on more debt. And more higher property taxes. It just doesn't make any sense. And that's actually why we started our company, because in 08, 09, 010, I saw friends and family lose everything, right? Because they felt they had no other option except for the 1031 exchange. And so now we believe it's the time to diversify. Now is the time to get out of debt. Now is the time to get into alternative investments such as the lending business. So Edwin, shifting a little bit here, I consider you a wealth advisor, right? You're in investment.
No.
Well, let me preface
I'm
that.
not.
Let me preface that.
Yeah. So I am not an advisor. I am not a CPA or financial planner or advisor. Nope.
So let me
Well,
preface
put that
that.
out there.
Okay. So yeah, you're not a CPA, not a financial advisor, you're not giving financial advice. But what I mean by that is you're going to help people with wealth decisions, especially as it pertains to lending and making a sound decision based upon what you have. I mean, you're dealing with people's wealth if they're going into your business. That being said, what should every other wealth advisor, whether it be the financial advisor, commercial real estate operator, syndicator, business broker, what should they know about what you do, and what are the best ones who work with you? What do they do to help grow their business and work well with you?
The lending business it's unique, and it is starting to catch its wings. You have a lot of people starting to be attracted to the idea of becoming the bank, loaning their money out and advising their clients to become the bank as well. There's several great books that have been written on it, and not a lot. If any of your listeners go and they say, hey, I want to learn how to become a private lender, and they type in private lending or learn how to be a private lender, what they're going to find are a lot of these real estate gurus or real estate people that are, hey, I will teach you how to be a private lender by loaning your money to me. That's not what you want to get taught, because you're basically being taught from a borrower's perspective, hey, this is why you need to loan me your money. You want to take somebody's perspective of, hey, we are in the business of lending our money. We are in the business of mitigating risk, of covering our downside, and having secondary and tertiary of action in case something does go wrong, which inevitably it will. Two books I would highly recommend your listeners to look into is one book by George Anton. He's actually out there in California, called The Banker's Code. It's a really short book, really brief, but it's to the point, and it's chock full of good information. The other book, and I'll send you the links after this, Brett. The other book is, and I forget his name, dadgummit. It's called Chasing the Yield, or Making the Yield, Making the Yield. And I'll have to get his name and a link to his book. But he gets really into the nitty gritty, the details of how to underwrite a loan, which is really, really important. So any financial planners, advisors out there that have clients that are asking them, hey, this is an investment technique that I want to explore. These are two great resources. I've written an ebook, a really short ebook, on the difference between investing in cash flowing real estate, investing in dividends, and investing in loans. Comparing the three, sort of pulling back the curtain on the pros and the cons of all three of those, so that someone can adequately look and say, okay, is this right for me, or is that right for me? Another way that planners, people that are wealth advisors work with me, it's very difficult. You have a lot of wealth planners and advisors that are what we call captive agents. So they work for the big firms, Charles Schwab, Edward Jones. They work for the big firms throughout the land. These firms, what they are doing with their investors' capital is not investing or even creating the opportunity to invest in what we call alternative investment strategies. That's what we are. We're alternative investments. A lot of captive agents are investing their investors' capital into the stock market. Now, the assets within the stock market that they're investing in. It could be mutual funds, it could be bonds, it could be EFTs, it could be a myriad of different blue chip stock. I mean, you name it, they're out there. So the investment firm's responsibility is to find and create these portfolios of investment products, and then that's what they sell their clients. So at the end of the day, if someone's investing into a Charles Schwab or Edward Jones, and they have these self-directed investments or self-directed IRAs, if you are with a captive agent, you cannot tell your agent, and I would challenge any of your listeners, if you have an account with Edward Jones, and I keep saying Edward Jones, I'm sorry to pick on them, any of these wealth advisors, if you have an account with them, ask them, I would like to take my investment account, and instead of investing in your company's products, whatever they are, and they may be good, but I've got a business, or I've got a loan that I want to invest, or a property I want to invest in, or a loan that I want to invest in. Can I do that with my account? They will probably tell you no. Legally, you can. That was drafted into the ERISA Act that was written back in the 70s. When that came out, it basically limited retirement account investments to you can invest in anything except for 4 products. I believe that those 4 products are coins, collectible coins, furniture, insurance policies, and gold bullion coins. You can invest in gold bullion, but you can't invest in gold or silver coins. So those are I think there's one other, but you can invest in anything else with your self-directed IRA or your retirement account. So if they are working with a wealth advisor, they should know if their wealth advisor is a captive agent, and if they're not, and they can truly advise them into different strategies and investment methods, then simply asking them, hey, is there a fund manager that or is there an investment group or a club that goes out and does these type of loans or does these type of investments? And that manager hopefully will know.
Perfect. You ready for the lightning round and the last question?
All right, let's do it.
All right. So you already kind of mentioned your favorite book, or at least the book maybe you recommend right now, but maybe you have a different one. With The Banker's Code, Making the Yield, any other favorite books come to mind?
Absolutely. My favorite book of all time is Extreme Ownership by Leif Babin and Jocko Willink, the 2 brother Navy SEALs. They really dive into the mentality of special operations and why we have that extreme ownership mindset, that even if it's something out of our control, we own whatever the results of that decision are. So
love that.
Extreme Ownership.
Love that book. And I got to read it again. It's so good. Best podcast maybe you listened to the last 6 months?
Best podcast. I'm a really big fan of apologetics. I listened to Frank Turek's Cross-Examined.
Awesome. Top leadership quote.
Goodness. A top leadership quote. Let's see. There's one it was J.D. Rockefeller. I don't want to own anything. I simply want to control everything.
Love that. Best place to retire in Florida.
Destin, Florida, up on the Panhandle. If you've never been, you have to go check out 30A, 30 capital letter A, some of the most beautiful communities out there.
And the last question, it's my favorite question, and I'm looking forward to what you have to say here. So how do you stay centered, Edwin, in your values and stay encouraged to reach to new heights? In other words, you've accomplished a lot. You've been in special forces. You've helped a lot of people. You're an expert in lending, and you've achieved so much. So how do you stay centered in your values and encouraged to reach to new heights?
I stay centered in my values. I spend every day. I spend time with God. I'm a follower of Jesus Christ. I am committed to living a life that would be exemplary of his life. So that's how I stay centered, as well as I have a wife, an incredible, beautiful Colombiana who is the same. And so when you have 2 people that are passionate about pursuing the same values and ideals, it makes life just incredibly enjoyable. And I surround myself to keep pushing to the next level. I try to find people that are smarter, more intelligent. They have more wisdom than I do. I literally want to be not the dumbest, but the least experienced and the least knowledgeable person in a room. That's how I continue to push on and push forward and learn new things and continue to reach for that prize.
I love that. I love that. Keep fighting the good fight. And I want to thank you for being on the show, sharing a part of your story, sharing your expertise and your inspiration with us. And I want to thank our listeners again for listening to another episode of Capital Gains Tax Solutions Podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust, a 1031 exchange, and maybe you're going to invest with your self-directed IRA now that you heard from Edwin, is the best way to grow your wealth. Until next time, go take some action on some of the knowledge you just learned. Thanks so much. What a great show. Edwin did an amazing job sharing his story and walking us through what he does and how he helps his clients. A couple things come to mind. Just the fact that the rights of a lender surpass the rights of ownership, and wanting to have control and not own anything by Rockefeller, that quote too. Taking a shift, and as life changes and seasons of life changes, so do investment strategies, right? And we just believe that now is a great time to sell high, get on the sidelines, tax deferred, pay off your debt, and diversify, especially if you've made lots of gains in the past 5 or 10 years. Again, this coronavirus is going on right now, and as we're taping the show, the marketplace has dropped drastically. And if you weren't diversified, if you are in a lot of debt, you could be in a lot of trouble. But now is a great time to sell high, pay off debt. Use the Deferred Sales Trust as that vehicle. We truly believe it gives you the most flexibility and benefits. And so check out Edwin also too at, again, deployedcapitalgroup.com. And as always, if you're looking for a consultation on your wealth plan with tax deferral, check us out at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. Thanks again for listening to the show. We look forward to having you listen to the next one. Thanks so much.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.